The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, as we're essentially halfway through 2024, we're coming up on the end of the 2023 marketing year as well. A lot going on in agriculture. I thought it was a perfect time for us to sit down and have a conversation with Chad Hart, ag economist with Iowa State University and Iowa State University Extension. Chad, welcome back to the program. It is always good to talk with you. How are you, sir?
I'm doing well, Jesse. It's a pleasure to be with you today.
Well, we got plenty to take a look at here, Chad. And I think just for starters overall, a lot has been said about the way commodity prices have acted here over the last several weeks. We've seen a pretty significant pullback in grains, corn, beans in particular. The wheat markets as well have been pulling back too. There's just been some added trepidation, I would say, across the overall commodity market, the ag economy, etc. I'd say, what's your assessment as we roll into the month of August here, just the overall feeling in these commodity markets right now, Chad?
Yeah, and I'd agree. I mean, that's the deal. We've seen a general downward trend sort of across the board. And I link it more to supply side issues than demand. When I'm looking now, what we see is from the old crop perspective, we're holding a heck of a lot of corn and soybeans in storage right now that's overhanging the market. As we look forward to new crop, we continue to see the crop ratings running well above the 5-year average, indicating that another set of bumper crops is coming in, needing that storage room to be utilized by farmers. And so you look at just the wealth of commodity that we have to sell right now that we think we're going to have to sell this fall, and it's just pressing down on prices. And that's despite usage being actually really good to darn near record. You look at the corn market, and USDA is projecting 14.9 billion bushels worth of usage for the 2024 crop. That's a record, but it's not enough to lift prices because of the big supplies. You look on the soybean side, it's the same deal. We're seeing, really solid usage numbers there, but just not quick enough to eat up all the crop that we're producing.
Well, I think about this too, and essentially it feels like, to your point, farmers are kind of feeling the pinch, feeling the squeeze across two crop years essentially here. The 23 prices as we're at the tail end, and then the 24, the new crop, we're just kind of feeling that depressed price environment and that kind of price squeeze really just across the board here as we kind of switch from one marketing year over fully to the next one, Chad.
We definitely are feeling it. And the idea is that the longer we sort of hang on trying to look for those rallies as we move forward, we're just continuing to move that pressure deeper into the year here. I mean, one of my big concerns is all the crop that we have right now sitting in on-farm storage that has not moved into the market yet we know needs to move into the market over the next 2 months to make room for the harvest we're about to have. How are farmers going to transition that out? And the minute they start to, it just adds on to that lower pricing pressure we've been experiencing for the past 6 months.
Someone made the comment here the other day and said, with the low price environment and making sure you manage your risk, someone said, well, just build more storage. I mean, that's one thought. Is it the best idea though at this point, Chad?
It's a thought, but I'm going to frame it this way. It's only a thought if you know how to manage it appropriately. Okay. I think farmers use storage. I describe it as like the field of dreams. They believe if they build it, those returns will come. But that's not the case with storage. Storage makes sense at certain times, but other times it does not. And what we're running into right now is we've been storing the 2023 crop now and then watching that price fall and fall and fall. We're not capturing those storage gains this year, and we're going to need to move off of that. Like I say, one of the biggest fears I have right now is both corn and soybeans. We're seeing an abundance of on-farm storage of both 2023 corn and soy. Corn, I think farmers are ready to manage for the long term in storing that corn. But when it comes to long-term storage of soybeans, that's not something that we usually do. And I like to remind folks that, if we don't know exactly how to do that, now is not the time to be learning in a low price environment. I joke that I grew up, in a locker plant. So grew up around the
Yeah.
livestock industry. I know a lot of terrible smells. But the worst smell I've ever smelled in my life was rotten beans that got stuck in a bin that, they went in as soybeans, but they came out as junk. And I fear that we're going to face a lot of junk coming out of the bins, especially on the soybean side, as we clean them out this summer, preparing for the 2024 harvest.
That's a very interesting perspective, and I'll take it a step further. If it's on-farm storage is one thing, but maybe you have some crops sitting at the elevator in storage that maybe they gave you free DP, for instance, but maybe that's run out. Maybe you're getting interest charges on some of that that's being stored now. That's a whole other situation as well. That could be a bit of a problematic sticky wicket, so to speak. I'm trying to think of all the different analogies here, but that could be another issue if you're in that situation as well right now, Chad.
It definitely can be. And that's the deal. I mean, we have to look at, when we think about storage, I think we tend to think of it as, okay, once we build it, those fixed costs are locked in, but we don't tend to think about the variable costs. As you mentioned, if we're at the elevator, we do think about that, but not at home. But with either, what you're looking at is, okay, are the cost of storing this bushel of grain for the next month going to be offset by gains in the price that we see out there? And the problem we've had for the past 6 months is we're not seeing those price gains. Therefore, storage is not paying off right now. Now, given that we're already in this situation, what can we do about it? One of the things we can take advantage of is look at where are we at in terms of our pricing, and can we see some recovery somewhere? For example, when I look here in central Iowa, we're still seeing some really good basis levels. And so one of the things I've started to talk about farmers as they hold on, as they've held on to their old crop corn and soybeans is, hey, how about maybe go ahead and move some of that today, capture this better basis, but then maybe look at the options market to give yourself some time, go out and maybe buy a call. And that way, maybe you can see some price recovery on the future side while keeping the good basis that you've got right now. It's a way to extend your pricing opportunity without continuing to add to your storage cost.
And that's a great point. And that's something that it obviously depends on how comfortable you are with your marketing and things like that. But there are tools in the toolbox to manage your risk, to allow you to leg into these markets, so to speak, and make some incremental sales, even though you might be below your break even, et cetera, et cetera. But there's opportunity here to manage the risk because there still feels like there is some downside pressure out there in these grain markets, Chad.
Well, that's the deal. When you look at the tools that we talk about, we oftentimes are talking about, futures and options hedging. And when you think about options, the beauty of options is that they create protection on the downside while still leaving you upside potential. Now, they do that at a cost. You do pay a premium. So in that sense, options are sort of like price insurance, but they do give us this opportunity, especially in an environment like today, when we know, like I say, our basis levels are pretty good, especially if I've got an ethanol plant nearby. Well, I want to take advantage of that and still give myself some time to hopefully allow futures to move to a higher plateau than what we're seeing right now. And options, like I say, give us that opportunity, but I do have to face the premium to do that.
And there's obviously a lot of risk out there, of course, but that's part of it, and just gotta be smart about it in this window. And I think too, another thing that's been talked about a lot here in recent weeks has been the layoffs at John Deere, Agco reporting a sharp drop in second quarter earnings, for instance. That overall ag economy, there's some issues there, and I think especially the case of Deere, they pointed to it: lower commodity prices, lower farm income, as being a big catalyst here. I mean, say what you will about the situation, it's tough, but you start seeing things like that happening in the broader ag economy, and that there's some concern out there, Chad.
Definitely is. And that's the deal. I think when you're looking here, what we are seeing is a downturn in the overall agricultural economy. It is similar to what we experienced a decade ago. When you think about, the high income levels we saw 2010, 2011 into 2012, and then we saw a downturn 13, 14, 15, 2016. We're going through something similar now. We'll go through something similar again, probably 7 to 10 years from now. Ag does tend to go through these agricultural cycles or economic cycles, just like the general economy does. We don't quite tend to line up with the general economy. And in this case, there is some concern that maybe the ag economy is leading with what the general economy could face in a year or two.
Mm-hmm.
But at least right now, what you could argue is the general economy is still growing, but the ag economy has pulled back. We do know farm incomes have pulled back. Definitely on crop pricing, we've definitely pulled back. On the livestock side, you could still argue, nope, they're seeing higher prices there, but they're facing sort of an opposite problem that we're facing in the grains. Grains, we got plenty of supply. In fact, demand can't keep up with us. When we look at the livestock side, especially the cattle, supplies are greatly diminished, yet demand is still really good. That's what's driving those prices higher, even though the crop prices continue to fall.
We're having a conversation today with Chad Hart from Iowa State University. Chad, let's talk some more about the livestock side, since you brought that up, and look at those markets here kind of halfway through the year. And I think in particular, cattle folks have enjoyed some very strong prices. They've enjoyed cheap feed prices here in this window. But I'm getting a little more nervous every day when I look at the cattle futures market. I look at boxed beef, I look at cash, demand, seasonal tendencies here. I guess I would frame it up as I'm cautious, and maybe the cattle rancher should think about starting to protect some of their risk as well if they haven't done so. What do you think about that?
I'm going to argue they should have been protecting their risk all along here, because there is a lot of volatility in the cattle market. We're all searching for two things. One, yeah, you're right. The seasonals would point to, okay, as we get towards the end of the year, and we saw it last year, the market does tend to pull back some as we get into the fall. At the same time, too, though, we know that this cattle herd is one of the smallest we've ever experienced in many lifetimes, and that eventually this industry will have to start growing its animals up again. But we haven't reached that point yet. And so I can point to some significant factors pushing us even higher. I can point to some significant factors that would pull us back down. So, the idea is in this case, that risk has turned into some really strong pricing for the industry as we look out right now. That strong pricing has, in a certain way, limited the industry's ability to restock animals to start to grow again, because the value of that heifer right now, she's worth, let's face it, she's worth her weight in gold in meat. Mm-hmm. And so it makes sense that we're continuing to route those heifers into the feedlots as opposed to into the breeding herd. But eventually we know that's going to have to shift. And when it does, we could see incredibly strong prices, because that will be limiting the amount of animals that are available to fill that shackle space. And that's sort of the catch-22 the cattle industry has right now. Yeah, prices are strong, but we know sometime in the future they're going to be even stronger.
I think that's some of why we've seen this explosion in beef on dairy as well, Chad. There's been a lot of talk about that. We've touched on it here on this program plenty of times as well in the last few months. There's just been a lot of uptick in bringing more beef on dairy production to take advantage of some of these good price levels on the cattle side.
Definitely has been the case. And when you think about it, that's the deal. The dairy industry has sort of stepped up to help fill in part of the hole. We have fewer beef cattle to work with, yet we continue to produce an amazing amount of beef given the animals that we've got. And it's the dairy herd helping supplement that has, I'll call it, softened the blow that like I say, that we know is coming. As you look at USDA's projections, they're saying in 2025 we're going to produce about 1.2 billion less pounds of beef than we're doing right now here in 2024. And that's with us throwing as many animals as we can in the feedlot. That's with the dairy industry supplementing the beef side to create more animals to create that meat. Yet we're still going to have a shortfall as we look out there. And that shortfall is going to get even larger if we don't start to retain some heifers, if we don't start to build this herd back up. But because of that shortfall, it also creates those opportunities for dairy, for example, to get some animals into the beef market to help supplement incomes on the dairy side. Because let's face it, dairy economics have been rather tough. And so you're looking for anything to help buttress that up. And hey, if I can pop off a few beef animals on the side, more than willing to do that for the market today.
Absolutely. How about the hog side of the protein sector? I know some of the same dynamics, but yet differences as well. Futures have had a nice rally the last couple of weeks as we've kind of maybe gotten back up to some good price levels in futures contracts. Cash has been fairly good. Demand has been good. What's your perspective on the hog side of things, Chad?
Well, that's the deal. It's demand is good, but where cattle are constantly facing the crush of limited supplies, pork is not. The idea is that the pork industry, when you look back at the past couple of years, has been trying to pull back. They've been reducing farrowings, trying to say, nope, we're gonna wean our ways back a bit. But productivity has been amazing within the pork industry. You look at pigs saved per litter, and even though we're farrowing less, we're creating a larger pig herd. And that's adding to pork supplies. And that has been the challenge that the industry is facing. They're trying to pull back, but they're still growing. And luckily, demand has been good enough to help soak some of that up. But I'd say that is the concern as we look forward, is that we continue to see those productivity gains on the pork side that are possibly going to outrace the good demand that we have.
Chad, good stuff as always. Final thoughts as we wrap it up here today. Anything you want to mention or reiterate to producers right now?
Well, one of the things that, on the crop side, I would say we're definitely looking forward to the August WASDE report. And the thing I'm most interested in, there's two numbers I'm really watching for basically all the crops. Harvested acreage across all the crops, because in this case, I'm going to argue the market is preparing for that higher yield, given the crop conditions report we're seeing. The wild card here is going to be acreage, given the flooding that we had, for example, in Northwest Iowa, given some of the, the slow planting that USDA even pointed to when they released the acreage numbers in June. We could see those acreage numbers come down and help soften the blow of higher yields. So if you're looking for positive stories coming out of the WASDE, that would be a place to watch. The other place to watch will be exports. We have started to see advanced sales for 2024 starting to pick up that seasonal pace, but we're going to need something stronger than that to help offset the higher yields that are likely expected here. So those are the things I'm looking for on the crop side. I think when you're looking livestock, the big thing I continue to watch is on the cattle side, heifer retention. Like I say, when I'm looking there right now, we've got 40% of our heifers basically going into the feedlot. We need that to go down in the sub 35% range to indicate expansion is underway, and we're not anywhere close to that right now. So I continue to watch to see what's happening with those heifers, because it's indicating when do we start to try to rebuild the industry.
Great conversation as always. Chad Hart, Iowa State University. Thanks for being with us here on the program today, Chad. We'll talk to you again real soon. Appreciate it.
All right. Thank you, Jesse.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.